Investors, while the stock market has certainly experienced some positive trading days to end the month of August, we were certainly in a downbeat trading month, and we need to take note of some recent reports like the job openings, consumer confidence, and most recently the non-farm payrolls as we head into September and gear up for the next FOMC meeting. But before we get into any of that, if you're new here, I'm Ari, your dividend investor here on YouTube, looking to share all the need-to-know economic insights and just gift you with new dividend stock ideas to ultimately drive more profits your way. As for today, I have exactly that on the agenda, so how about we just dive right in. Now, if you caught my last video where I shared my August dividend income, the day of that recording, the market was actually in the red, but yet here we are entering the month of September on at least a higher note, and my account's now hovering around $121,986.98, which just goes to show all of us how volatile the market can be in a matter of a day or two. And essentially, we need to be asking ourselves, why such a state of market flux, uncertainty, and volatility? Not for the sake of timing the market, but to get in the know to ultimately then understand where to look in terms of the right sectors and of course the right stocks. Therefore, as you all probably know, I am a huge macro matters type of guy. And that's very similar to Peter Lynch. I mean, we're looking at all these economic indicators and really I'm seeing uncertainty brewing and therefore a downturn coming our way. But not because all the news that has been bad. Actually, I'm worried because recent headlines have been pretty good, like job openings falling to a 28-month low, whereas job listings last came in at 8.8 million on a report when we expected 9.5 million listings. In addition, the latest when it came to consumer confidence, confidence dropped from 114 to around 106, meaning there were slightly less people in August saying jobs are plentiful and they're confident in the market. But wait, what? How is that not bad? I mean, how is that actually good? Well, I guess it depends on who you're asking, but if you're asking Federal Reserve officials like Jerome Powell, well, we were last looking at the non-farm payroll report that was released on Friday, also depicting some weakness, is all a step in the right direction and essentially slowing the entire economy down to get a stronghold on inflation is exactly what they want to do. Because if we don't,
as is often the case, we are navigating by the stars under cloudy skies.
Now, on the other hand, what does trouble me as an investor is that interest rates are high, like really high. And although we have been living in this Goldilocks type of dream scenario of the market still performing quite well, all chickens usually come home to roost. Which is to say, it is really a matter of time that businesses can just continue to thrive in such a high interest rate environment. Heck, if the Fed hikes rates again, I don't think it will be that much different because we're already playing who can survive in a survival of the fittest business world right now. But here's what I love about this whole macro picture. Opportunities are revealing themselves to investors like us. You know, those seeking discounted share price and a long-term hold. With that, let's dive into the first dividend stock of the day, a financial sector play I mentioned not too long ago, Discover Financial, ticker symbol DFS, which is in the business of both banking and predominantly operating lending lines, whether it's with personal loans, home equity, student, or just your run-of-the-mill credit card loans. Now, recently, Discover has been under the scope of regulators, which ultimately led to their CEO being ousted, which now, depending on their ability to pivot, can create quite an opportunity. But it's also now important to note that doors have now been opened up for a potential acquisition, which could make this a bit riskier of a play. That's just a fair warning. However, we can find Discover right now down by 5.6% on the year, trading for around $89 per share with a PE ratio at 6.2. Yet it's been interesting to see a lot of investors have nonetheless been pouring their money into this position, and Wolf Financial seeing an opportunity as well, with other firms like Morgan Stanley downgrading Discover. Wolf Financial upgraded the financial giant, betting that these woes won't last. Now, we also see plenty of analysts with upside forecasted, about 26% worth of it coming up to $113.53 per share, along with hedge funds who have remained bullish and they're only scoring more shares worth of Discover. And given we are here for the dividend, should Discover recover, we have a nice dividend to enjoy at a 2.82% dividend yield. Next up, if Discover was a little too risky for you, I understand, but how about this next one with Texas Instruments, ticker symbol TXN, which as we know to be a leader in the semiconductor and the circuit space with such a heavy demand, especially heading into the future. But right now, with supply and demand shifts taking place, we do see Texas Instruments recently on the decline from a peak of around $186 per share, now trading for $169 per share, with the PE ratio coming in around 20. So I want to say keep your eyes on this one, only because it's a solid company that could get even cheaper in due time. Now, noteworthy to see retail investors out there already buying Texas Instruments back up right now, as well as analysts forecasting 9.62% worth of upside to a share price of $185.51 per share. But until then, shareholders will enjoy that rock solid dividend yield coming in, doubling the sector average at 2.9%. Now, just before I get into this next dividend stock, if this video is being helpful to you as an investor, tapping on that thumbs up button or subscribing would mean a whole lot to me. Now, doing so ultimately gives me a strong indicator that I'm building an audience out there and, more importantly, creating helpful content for investors. So again, just tap on that thumbs up button and subscribe if you're not already on this journey with me. It would mean a ton to me. With that, let's talk Darden Restaurants, ticker symbol DRI, which has also been mentioned 2 or 3 times within the last 2 to 3 weeks, which should sound some buy alarm bells for you. Now, if you're not familiar with Darden, in short, it's a restaurant operator within the United States overseeing some pretty reputable restaurant chains, like the all-famous Olive Garden to the Longhorn Steakhouse, Seasons 52, the Capitol Grill, and Eddie V's. And right now, this restaurant behemoth is actually sliding as consumers seem to be prepping for all this uncertainty to come. It's not down on the year as of right now, but it's way off the peak of $172 per share, trading for $157 per share. That PE ratio is below 20 at 19.4. Now, Darden could continue to slide even more, which is very likely, especially we see some smart money signals that haven't been too positive, and likewise when it comes to insider trading moves. But keep it on your watch list because it has added some serious firepower to my dividend portfolio. As for analysts, there's upside expected, nearly 12% worth of it, coming up to a share price of $175.94, and until then, a nice 3.17% dividend yield to enjoy. Next up, let's discuss General Mills, ticker symbol GIS, which is a manufacturer of branded consumer foods throughout retail sellers literally everywhere. We're talking about your Fiber One bars, Chex Mix, Betty Crocker baked goods, Dunkaroos, or my personal favorite, Cinnamon Toast Crunch, which I need to say here, I'd be interested in investing into General Mills if they were literally only selling Dunkaroos and Cinnamon Toast Crunch. So as the stock plummets, already down by about 16% year to date, trading for $68 per share with a low PE here coming in at 15.9, General Mills certainly has my attention, especially with analysts forecasting a share price of $80.07 per share. It's roughly 17.2% worth of upside. And until then, we get that recovery, and all of a sudden, we're also enjoying a 3.23% dividend yield. Now, coming up to our 5th dividend stock, it is the one that has previously been in my portfolio that I also recently mentioned. It always piques my interest during periods of heightened uncertainty, Omnicom, ticker symbol OMC, which is the world's largest, if not the largest, marketing, communications, and advertising umbrella company out there with a global presence in over 5,000 clients. It is quite a powerhouse, but let's be clear, when the market flops on us, companies always scale back on spending, and it's without fail that we always cut back on spending when it comes to marketing and advertising budgets. That's sad. But this means now we have Omnicom trading for around $80 per share, down from a peak of around $100 per share, with a current PE ratio of just 11.9. But when their clients like Nike, McDonald's, Pepsi, Visa, and Apple are all looking to ramp up their advertising once again, I have no doubt that Omnicom is going to get that first call, which is likely why we see analysts with a price target coming right back up to $100 per share. It's about 23% worth of upside, and both for passive income and reliability, you can find it in Omnicom, given their dividend yield is way over the sector average here at 3.47%. And while on the topic of safety, let's talk about a healthcare giant that will surely deliver through on just that well into many moons to come, Bristol Myers Squibb, ticker symbol BMY, which is one of the world's largest pharma companies and is consistently ranking on the Fortune 500 list of largest US corporations. Now, I'm going to make a very simple argument for a healthcare investment like this, especially in the pharma space. everyone is always going to need a treatment of some kind. Now I'll end my mini rant there to share that we now have Bristol Myers down 11.49% on the year, trading for $62 per share at a PE of 16.7. However, a red flag signal here is with recent insider sells, which could mean more downside as in the near term, but with plenty of firepower from hedge funds coming in for the longer term. I am just a fan of Bristol Myers. As for analysts, almost 14% worth of upside expected, coming up to a share price of $70.91 per share, with a solid dividend yield above the sector average coming in at 3.58%. Now, last but not least, a defensive dividend stock, both literally and dividendly speaking, that has all the green flags that are up right now, from a discount on the share price to smart money moves being made on it right now. Let's talk about Lockheed Martin, ticker symbol LMT, which is the world's largest defense contractor, with none other than the United States government being their biggest business partner here when it comes to their book of business. Their latest round of deals secured with the US Navy, ranging from a $315 million modification deal to a $2.7 billion, $606 million, and $347 million deal. Yet the stock is trading for $452 per share. That's $50 off its peak, with a PE ratio at 16.4. And as insiders at the director level are investing more into Lockheed, analysts are also forecasting a rebound share price here, $494.62 per share. That's about 9.3% worth of upside, to which shareholders would then reap a massive benefit of a 2.63% dividend yield on top of share price appreciation for certainly what is very likely to be years to come. And there you have it, 7 dividend stocks worth your attention right now. But now I want to know your thoughts on these 7 dividend stocks, or if you have better ideas out there, drop them all down in the comments below, and you are one click away from another good video. But before you go, be sure to tap on that thumbs up button and ensure you're subscribed to the channel to never miss a single video.